Well, we're just into April, indeed, the second working day of April, and David Bacher from Corion is with us. David, good to be in your company again. We're looking back on the first quarter of 2024, which has way outperformed anything most people were believing was possible for the investment markets. And indeed, we're looking back at the month of March. We're going to go through a presentation that you've put together for us. Thank you very much. But before we go there, just from your perspective, did you anticipate Q1 24 to be anything like what we've just experienced?
I think the actual makeup of the market returns surprised us. It was a continuation of mega caps, the big stocks driving global returns, particularly in the US. From our side, we're starting to go much more overweight other parts of the market. So short answer, I think the distribution of the returns did surprise us, and it was largely carried by those, I would say the fabulous four. I suppose the magnificent seven, given what happened last quarter, is probably less relevant, given what happened to Tesla and Apple, but certainly mega cap shares drove the US markets.
Yeah, you mentioned Tesla. We've now added that to the BizNews model portfolio. We thought under $200, good price. Fortunately there, it's purchased in one third, because the second lot of shares we bought, the share price was down below $180, and I see it's now below $170. So it just shows trying to time purchases it's a foolhardy game, isn't it?
It is indeed. I mean, Tesla came out, I think yesterday or the day before, saying that, it missed its production targets. I think it's getting a lot of competition from China, where there's price wars happening. So, you buy into the story is one thing, but as you said, you never know exactly where the bottom is. So Rand cost averaging is something that I think any sensible investor should follow.
Explain that Rand cost averaging, because I know we have a lot of newbies to investing who watch and listen to this discussion and to try and pick up some insights. That's a very, very important part of one's whole investment strategy.
Yes, I think so. Rand cost averaging, and when you're investing in a volatile asset such as equities, just missing one day's return could make a big difference. So, you might over a very long term believe in the story or the share delivering the earnings that you expect. But buying that share at, let's say, 100 Rand versus 102 or 95 on any particular day is quite meaningful. So, what most people do is they try and eliminate the noise. They try and eliminate the actual exact timing of when you buy that instrument, and rather on the way in and on the way out, rather do it in stages. It gives you a less volatile return, and your ability to pick the stock is more got to do with, let's say, skill as opposed to the exact timing of your entry points.
You try and eliminate the spikes in share prices up or down. And we've been doing that in our web trader portfolio now for nearly 10 years, and it really has worked out for us, where in certain instances, you can kick yourself because when you buy in month 2 and month 3, the share price has gone up a lot. And I know we had that with NVIDIA, for instance. But in other instances, when it goes down, you win on that side as well. So a very sensible approach. Try not to pick a particular day. But let's go into the presentation for the month of March. And it really has been, as we mentioned earlier, a month to remember for many sectors of the market, but not least the gold bulls.
Yeah, I mean, gold is up 10% since the start of the year. That's roughly on par with the S&P 500. So eventually those gold bears, bulls have got something to smile about. And you have to ask what drove that gold rally. I think there's a number of reasons. The prospect of monetary policy easing by major central banks is certainly one of the reasons, and there's elevated tensions in the Middle East and Ukraine. But I think the strongest reason is probably central banks, particularly China, starting to buy gold and increase their reserves. I think that's probably the main catalyst behind the surge in gold price.
And younger people doing even better because they're not buying the old man's investment or hedge against inflation. They've been in Bitcoin, and boy, that's had a particularly good month. But overall, equities haven't done badly.
Yeah, it was nice for 1 month at least to see South Africa on a dollar basis outperforming, even though it was slightly the rest of the markets. But given what's happened over the last year, we'll take it. Pretty much a broad-based rally across the globe, with most markets ending up positive.
South Africa helped, no doubt, by the resources shares and particularly gold shares. But when you look back over a period of time at the asset class returns, it's quite interesting to see that South African equities now on a 5-year basis haven't done that badly. Not as well as global equities, but certainly outperformed bonds.
Correct. Over the longer term, you'll hope that equities outperform bonds, given it's a lot more volatile and a riskier asset. So investors expect to get compensated for that. But if you look at that 1 year number, global equities up 34%, and South African equities up 1.5%. So that's a major dispersion of returns. And the rand only depreciated 6%. So the majority of that underperformance is actually our equity market, unfortunately, which is, been up against it in terms of a depressed economy and, as you said, a resource sector that has been under pressure.
Also, the concerns about the election, or uncertainty rather about the election. It's still binary, isn't it, David? If the election goes one way, we could see this market in South Africa rocketing. If it goes the other way, it's probably fully discounted anyway.
Correct. I think the market's been very, very quiet. I read an article the other day that 74% of South African fund managers think our bond market and our equity market is undervalued. So, if the locals are buying and believe in the story, then obviously the foreigners aren't. So I think it's a bit of a wait and see before you get some big price movements. And I think you will get price movements one way or the other after the election.
Well, we've got quite a good news story for South Africa that we're going to be giving to our community in London with a event that we're holding, a conference, a one-day conference that we're holding there on the 15th of May. It'll be interesting to see if many of the asset managers come along and actually have any interest in South Africa, because it has to be now at a point where if you're looking for an outlier globally, it surely has to be giving you some very good perspective or opportunities. But the big play, I guess, has been China v. India, hasn't it? Where a lot of fund managers have been going short China, long India. And that strategy for the last 4 years has certainly worked out.
It's been an amazing rise of India relative to China. If you look at the 3-year returns, the Chinese market is up 18% per annum, while the Indian market is up almost it's down. China was down 18% per annum, and the Indian market was up almost 18%. So if you invested a million rands, your one asset in India would be worth almost 150,000 rands, while your Chinese assets would have halved. So it's a big dispersion of returns. And, when people say they think emerging markets is a place to be, if you go to the two biggest weightings, China and India, and you can see the dispersion of returns within that market, it teaches you a lesson that you can't really paint such a broad brush in investing. You've got to be a little bit more specific these days. And now you've got India, which used to be 8% of the emerging market index, now being 18%, and China was 44%, and then 4 years later, has gone to 25%. I think your makeup of where you want to invest in emerging markets is very different to what it was a few years ago.
Just to correct that or clarify, if you'd put R1 million into India, is it now worth 1.5 million rand? Not obviously 150,000 rand.
Oh, sorry, correct. 1.5 million rand over this 4-year period, or 3-year period. So if you compound 18%, you're up almost 50% over that 3-year period.
Whereas China is halved. Wow, that really does tell you the story. And then cocoa prices, that was something that was quite big in the month of March. What goes on there?
Yeah, it's not a commodity that you generally focus on, but I think it's always nice to see how demand and supply dynamics can change things very, very quickly. And when you have, almost a 250% increase in a commodity in a few months, it means that there's big things happening with that commodity, and poor climate and crop diseases in West Africa is the reason. It's home to about 70% of the global cocoa production. So when you have tightened supply, you get the prices skyrocketing. And so, I think if I was an Easter bunny, I might have considered hoarding all the chocolates this last weekend.
Yeah, there've been lots of stories about chocolates and chocoholics and having a difficult time over the most recent period because of that. Coming back home, half hawk, half governor, Lesetja Kganyago. Well, he has got a new 5-year term, which is good news for South Africa. But what do you mean by when you call him half hawk and I suppose half governor, not half dove?
I think we've got a very responsible Reserve Bank governor, and the terms hawkish and dovish actually originate from the behaviors of the birds, and are used metaphorically to describe the attitudes towards monetary policy and interest rate policy. So when someone is described as hawkish, it means they favor a more aggressive stance. In economic policy, a hawkish stance typically refers to high interest rates to combat inflation, even at the risk of slowing economic growth. And I think that describes our governor's positioning. While inflation forecasts have not changed materially, the tone of all the governor's comments and rhetoric has certainly been biased towards keeping interest rates at current levels and protecting the rand and protecting what ultimately he believes is the bigger evil being inflation, which has a bigger long-term impact on the poor.
I'm glad you say protecting the rand. I don't think too many people are going to believe you on that one, David, but it could be a lot worse. And just generally having a look at the returns of the major asset classes?
Yeah, it certainly was a tale of two kind of halves. The resources sector was up, almost 13%. So that carried our equity markets. But if you look at more the interest rate sensitive shares, the banks, the insurance companies, even our local bonds, that was under pressure. And I think that's got to do, obviously, with a depressed economy, but also concerns that interest rates are going to be kept higher for longer.
It's funny. We've been following this every month, and I felt like I keep thinking, hey, David, is it right time to buy resources now? Because resources are doing poorly, and they're at the bottom of the pile, and they are cyclical. Well, they've had a good month in the month of March, but is it too late to get on board that wagon, given that they're the worst performing asset class over the last year, down by 11%, as the winner being property at up by 20%?
Yeah, it's a hard one to call. It will obviously be driven largely by the underlying commodity prices, potentially the impact of a China rebound as well. So I suppose some people might argue if you're bullish China, you should be bullish South African shares and resources. So there is an interplay there. It's hard to make calls on one factor and one driver of a commodity. And even if you do think that commodity prices are expensive or cheap, then you've got to say, well, which commodity prices? So, gold shares have an unbelievable period, while platinum shares, with the exception of last month, have gone completely the other way. So it really depends on which commodities and which resources.
And the worst performers are financial shares in the past month anyway.
Yeah, I think all four of those shares that we show here, Standard Bank, Absa, Discovery, and Remgro, came out with poor results or trading statements. Absa and Standard Bank came in below expectations. Absa in particular had an increase in provisions that were higher than the market expected. Remgro announced a big setback with its acquisition of Heineken and its operating performance. And so Discovery come up with poor results. So I think, not directly interlinked, but the general theme is the South African economy, the consumer has been struggling.
And on the other hand, the resources shares, some of them, well, the highly marginal gold miner Harmony, it's not just one mine, it's many mines, shooting the lights out.
Yeah, it's just amazing how geared these shares are to the underlying commodity price. And there's a lot of very good asset managers in South Africa who just can't get their mind around buying gold because, as I said earlier, it's driven by one factor which is hard to ascertain. But if you don't have those shares, when those shares run, you can look very sheepish, and that's what's happened. So, if you were a asset manager that holds gold shares over the last 3 months, you would be outperforming. But there's many who unfortunately didn't.
A little bit like Bitcoin as well, isn't it? And overall, David, interesting with the election coming up in, it must be just about 70 days' time now. Are we looking at a time when, if the downside in South African shares is so limited because they've fallen so far, and you really could have upside if the electorate were to vote rationally, which they never do, but anyway, perhaps this time, does it not give you a bit of a one-way bet, perhaps?
One way is a bit of a stretch. I mean, investing is always priced for risks and returns. So, but I do agree with you. I think from the balance of probability, the payoff profile, at Corion, we certainly are valuation driven. And if you look at the risks and where these shares are trading at, I mean, ABSA, you're getting, and Standard Bank, you're getting dividend yields of 9%. And you can argue that, the banking sector is under pressure and it's heightened competition, all very valid points. But a dividend yield of 9%, given the backdrop, we think you're compensated for that risk.
Yeah, those banking shares are really, really yielding incredible returns, and their forecasts are for better years ahead. So it's almost like if you were getting a 9% dividend yield, you would think that's because they're going to have a bad year to come. But actually, all of the forecasts, certainly the details that I've been reading, they're suggesting that they'll do even better this year, or at least double-digit profit growth.
And their capital adequacy and the balance sheets are very strong. So there's no concerns that we see in terms of solvency or banking crisis, etc. Their capital base has never been stronger. So yeah, we see it very similarly. High dividend yields, sound banks, good management. We think that if you buy probably all 4 of the big banks, and you have a 5-year view, you'll be compensated.
So what do you do right now? Give us your Corion house view and the David Bacher view, which I hope are aligned, when you look at the investment markets after the first quarter of 2024, which was a very good one for investors.
I think it's still, we haven't changed our thinking, shifting from US large cap to other areas of the market. I think, China is at a P of 10. So although South Africa's cheap, you could also say China's cheap. So, you've got to diversify between different markets. And China's obviously got its concerns and its risks. But once again, that's why the market, we think, is trading at a 10 PE. So you've got more than enough compensation. So I think although equity markets are at all-time highs, you've got to break that down, and you've got to realize that 70% of the equity markets is the US. A large portion of that is the large caps. That might reflect where global indices are, but it doesn't really reflect where we see opportunities, and that's pretty much in other markets.
David Bacher from Corion Capital, and I'm Alec Hogg from BizNews.com.